Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. We cannot wait to get stuck in with you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Somewhat nervous because in this episode, you are going to say the most controversial thing an Australian finance commentator can say, which is...
Go cash.
Which is you don't always make money in property. You've done the maths, you've pulled up a spreadsheet, you sent it to me, and we're going to work through those numbers and explain what we mean. We're also introducing a new expert for our Pimp My Portfolio segment.
Yes, yeah.
Charlie Viola
Yeah.
is joining us on the podcast, and we're going to cover some of the news that caught our eye.
News and markets.
Well, Ren, to kick things off, our Monday's episode is wildly out of date because we were talking about the Dockworkers strike over in the US.
Yeah, we were talking about $5 billion a day impact on the economy, how we'll have an inflationary impact on Australia.
Yeah, shipping was going to shut down.
Between when we recorded that episode and then when we released it, the Dockworkers came to an agreement with their employers. We should be clear, though, that we're not out of the woods yet. They've just postponed the strike until the 15th of January. I think the hurricane that hit large parts of the US was a pretty big motivating factor to say now is not the right time. Like, there's a duty to get supplies into the country.
Big time.
So it was good that they eased up on the strike. Not good for our content, but there are more important things in the world.
Yeah, I think they got 62% pay rise at the end.
Over 6 years.
Over 6 years.
Yeah.
Well, there you go. Anyway, you're right. There are other things to talk about. Rio Tinto, they are looking to become the world's third largest producer of lithium.
Yeah, so they are looking to buy Arcadium Lithium. Both companies acknowledged that they were in takeover talks. And Rio is looking at lithium despite the lithium price falling more than 80% from its all-time highs in 2022.
Yes. I mean, now's the time to get into it, to be honest.
Well,
asset prices are, all these producers are either going out of business, on their knees. Value of assets are down as well.
Yeah, so Arcadium is currently valued at 4.8 billion Aussie dollars. Macquarie Bank did a sum of its parts analysis not too long ago and said it was worth 8.5 billion. So, I mean, to your point, a lot of these lithium players are massively undervalued. Now, you are pretty happy with the old lithium turnaround story because, maybe a month ago you spoke about how you'd bought some Mineral Resources.
I reckon even less, yeah.
And for people unfamiliar, Mineral Resources is a mining services company. They process a lot of iron ore for a lot of the miners, but they are also getting into the lithium game themselves. And they've been beaten up as the lithium price has fallen and the iron ore price has fallen. But it seems like the mining industry are listening to Equity Mates because you managed to time the market pretty well.
Yeah, absolutely. Well, they called the bottom of the market on a Thursday, I think.
Minres did.
Yeah, the bottom of the lithium price on a early week, and then I got in late that week, and since then it's up 75%.
It's crazy. It's crazy.
Anyway, we'll see how that pans out.
I don't think we can say that lithium is structurally out of the woods yet.
Yeah.
Like, there is still a short-term supply-demand mismatch.
Big time.
It's going to be a crucial metal for the electric vehicle revolution, and that is what Rio are betting on. That is why they are going so all in on lithium. We've seen a lot of Aussie companies try and do takeovers and them not be successful. BHP tried to buy Anglo American, the big miner. REA Group tried to buy Rightmove.
Yes.
So hopefully Rio can have some more luck than some of those other big Australian companies. But one thing I find quite interesting is that Rio and BHP are diverging. Like, they both have a green metal strategy. So they're both, the last generation of Rio and BHP's growth was coal and iron ore, particularly iron ore. They both are now trying to get into green metals. BHP is getting into nickel and potash, copper, and Rio is going all in on lithium.
Yeah.
So it's just interesting that these two big Aussie miners as they diverge in the green metals that they're chasing, you would think over time their fortunes could diverge as well. Or all green metals could do well, and they all keep doing well. Who knows?
And where does Twiggy sit? Where's Fortescue?
Well, still iron ore.
They're
Like,
just
he's been pure play
main
iron ore.
He went hard personally on
Well,
hydrogen.
well, that's Fortescue's future industry,
Yeah,
so it's
yeah.
still part of Fortescue.
which I think he's pulled back heavy.
Yeah, so hydrogen is not having a great moment at the moment. Origin Energy pulled out of their hydrogen plays as well. So that is going to be one to watch.
Absolutely. Well, to close out, the Bank of Nan Pop is now making headlines. We've had the Bank of Mum and Dads helping their kids buy houses or get into the housing market. But now we're seeing the Bank of Nan Pop helping Gen Z home buyers, so the younger generation get into the market, with now 12% of Gen Z home owners saying that they've received help.
Yeah.
1 in 8.
1 in 8.
Yes.
Now, look, we put this on our Instagram, and there was a comment, 12% isn't a lot. I think 12% is a fair bit, getting help from their grandparents to buy houses.
I agree. Yeah.
In terms of education costs, 1 in 5 Gen Z reported getting help from grandparents.
Like uni.
And yeah,
Okay.
or school, I guess. Yeah. And I think this is a symptom of a broader story that is worth paying attention to. Because for about 10 years, the finance industry has spoken about the great wealth transfer.
Yeah.
I think the number is, like, in Australia over the next 20 years, $3.5 trillion will
Yep.
be passed down, mainly by baby boomers, to younger generations. And for context, baby boomers, the youngest baby boomers are just turning 60,
Yep.
and the oldest are in their late 70s. So they're in that, like, prime retirement, thinking about passing on their wealth. Like, the great wealth transfer has been happening for a little while because the Bank of Mum and Dad were these boomers, but now they're becoming grandparents,
Yeah.
and we're seeing them pass wealth down another generation as well.
Yeah.
The amount of wealth that's consolidated in baby boomers is crazy. They're like 20-something% of the population in Australia. They own 48% of the wealth. And the decisions they make about how and when they pass on their wealth is going to have major impacts on the economy.
Massive.
The Bank of Mum and Dad as a lender, these are numbers from the AFR in 2021, so might have drifted slightly, but the AFR put them as the 9th biggest home loan lender in the country with a loan book of $34 billion.
Crazy. Yeah.
And that's parents helping kids. The Bank of Nan Pop might become a major lender in Australia in their own right as well. So I think it's just a reminder that, like, this is going to be one of the defining financial stories of our lifetimes. This great wealth transfer from baby boomers down the generations.
Yeah.
And this is another place where it's popping up.
Yeah. Well, I know a family. We have a family friend whose grandparents still alive. They decided, we're going to pass some of our inheritance to their kids and their their parents' age, like our parents' age, and those parents then just sent it straight through to the kids. And so exactly that, this wealth transfer from grandparents to their kids down to the younger kids, and then they went straight into property.
Yeah.
So I think 1 in 8 is significant to your point in economic impact. Like, think about being at an auction. That's a significant percentage to be going up against someone with that sort of help.
Yeah, definitely.
So,
I mean,
watch this space.
yeah.
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 All right. Well, if you want to keep up with the headlines, make sure you subscribe to our daily newsletter, where we'll send you headlines from around the world every day straight to your inbox. There will be a link in the show notes to sign up to that. Word on the street is people are now reading it instead of the AFR. So stay up to date.
All right, well, Bryce, I said at the top of the show I was excited and somewhat nervous for this segment, because what you're about to present is sacrilege in some parts of the Australian finance industry.
A spreadsheet.
Doing
the work.
No, the Australian property is a one-way ticket to financial freedom.
Yes.
That has been an age-old adage passed from generation to generation
Big
of
time.
Australians. And you are coming to this podcast and telling us that you don't always make money in property.
What got me thinking about this was the common belief that, quote, property doubles every 10 years.
Yes.
You hear it all over the place. And so I thought, well, if that's the case, taking into consideration all the costs that go into having a principal place of residence, so I'm talking principal place of residence, over 10 years, what do you actually walk away with at the end of this? Because my intention here was not to shit on property or try and make some sort of argument that stocks are better or anything like that, but I just wanted to know, what do you actually walk away with?
And we should just say, before you get too into the numbers, the idea that property doubles in price every 10 years isn't crazy.
No.
So we've pulled some numbers over the past 10 years. This is according to CoreLogic. Sydney is up 107% over the past 10 years. Melbourne is up 82%. Brisbane is up 87%. Hobart is up 86%. So, you know, like, Sydney's a tiny bit more than doubled. A number of those other cities have almost doubled. Yeah. So, like, it's not a crazy thing to say.
The saying is true
in some circumstances.
Yes,
so we'll get
and
to
that's what I wanted to dig into. So I pulled out this, dusted off Excel and pulled out and put in some numbers to actually see what is the true cost of housing over a 10-year period. Now, some of these numbers will definitely differ between 1 and 2 beddies, 3 beddies, whatever, but I just wanted to run through it. So starting out, so keeping in mind principal place of residence. So starting out, a purchase price of $1.2 million.
Yep.
I put down a 20% deposit, so no lender's mortgage insurance. That's a cost that has been excluded here. You've got a loan of $960,000.
Yeah, and a deposit of $240K.
And a deposit of $240K. So my investment into this is $240K. Let's assume... Which is ridiculous.
Yeah. To go back to what we were talking about earlier, this is why you need the Bank of Mum and Dad and the Bank of Nan and Pop for a lot of people.
I know.
And that 1.2 million purchase price is lower than the median price in Sydney at least. Sydney's what, like 1.6, 1.8?
Which I was astounded by.
Anyway, separate conversation. Stick to the maths you've got here.
So let's assume that the adage plays out and over 10 years, my property grows 100%. Yeah. $2.4 million is... the property value.
And that works out to be a bit over 7% a year growth to double in 10 years. So not crazy, but it's growing.
It's achievable, yeah. So then you got to look at the costs that we're all familiar with. Stamp duty is on the purchase of about $51K. Application fee, legal fees, and agent fees. So your application fee of about $1,000, legal fees of about $4,000 to buy and sell. And then agent fees, unless I've got this wrong, you actually only pay the agent fees on the sale. I don't remember paying agent fees when we bought it.
That sounds right.
According to CoreLogic, average agent fee is about 2%. So 2% of 2.4 million, you're paying the agent $48,000. Jeez.
Okay, so you're jumping ahead here. You're including the buy and then the sell at the end of 10 years.
Because for me, I'm doing my balance sheet here and working out what I walk away with.
All right, keep going.
Over the 10 years, I've then paid about $60,000 in strata. So that was about $6,000 a year. Is that fair? You own an apartment? $15,000 a quarter, reasonable. Thereabouts.
Yeah. Oh, okay. So we bought a $1.2 million apartment.
Okay. I felt, yeah.
Okay, yeah, cool. Yeah, that's reasonable.
And I guess if you have a standalone property, your strata is probably then building and contents insurance or thereabouts. Utilities, I said about $16,000 over 10 years, which I still feel is pretty reasonable, about $300 a quarter or thereabouts. And insurance of about $15,000 as well, contents insurance, whatever it may be. So that
over 10 years.
Over 10 years. Yeah. So those are the costs. Then you have to hit your mortgage. Now, assuming a 6% interest rate, which is fair for now, and no, I haven't assumed the rates go down over this period, just fixed 10. Because of the way home loans work, the first 10 years of a principal and interest, you're actually spending most of the time paying off the interest. So after 10 years, you've only actually paid $154,691 in principal. You've paid over $500,000 in interest. So in total, you've paid $719,000 with a remaining balance left on the loan of $800,000.
Okay. From an initial loan balance of 960.
Yes. So 10 years later, you still owe $800,000.
Yeah.
So I've sold it. I've got $2.4 million in the bank. I need to repay $800,000, which gives me a gross profit of $1.5 million. Sounds great. But then I've got to take into consideration all my costs. So my costs are my interest payment of just over $500,000, plus insurance, utilities, my strata, all of the stamp duty, application, legal and agent fees. After all of that, considering no tax because of the capital gains tax exemption on a principal place of residence, you're left with $834,000.
Okay, so to wrap that up in a nice bow, you put a $240,000 deposit down, and at the 10 years later, you walk away with over $800,000 in profit.
Sounds pretty good.
So this segment was going to be, you don't always make money on property, and you've just said, oh, well, you can almost 4x your money in 10 years on property.
Yeah.
So that doesn't feel like the point you were trying to make.
It doesn't feel like the point I was trying to make, does it? No. But Ren, where you need to be careful here is as soon as you start playing with the return figure, which is that 100%, you start getting significantly different outcomes.
Yeah. So let's start by saying the adage is wrong. Property doesn't double every 10 years universally.
No.
Because we know there are times now, and there have been times throughout history where property has been flat over a 10-year period. Sam Gordon, who's our resident property expert here at Equity Mates, often speaks about that period in Sydney from 2003 to 2013, where prices were essentially flat, bookended by two booms either side of that. Or what about today, over the past 10 years, Darwin down 0.4% over 10 years.
There you go.
So there are times when you actually get no growth.
Yeah.
So what if I ask you to update your spreadsheet and say,
Please.
change that 100% growth figure to 0%?
0% growth. We're in a period of stagnation.
In theory, you're still paying off your mortgage every month.
Nothing changes.
So you think you're building equity.
Absolutely.
So don't change any of your other assumptions.
The only thing that will change,
don't need to go through all those costs
I won't.
again.
But the only thing that will change is the agent fee because it's a percentage of value.
Yep.
So that's automatically changed. Everything else remains the same though. You actually come out $341,000 in the red.
Yeah.
So you've put in 240,000. You've had all of these costs. You've lived in the place for 10 years. You then go to sell it and you think, oh, great, at least I have sold it for what I bought it for.
Yeah.
Wrong. You've actually walked away.
Well, no. So to be clear, you have sold it for what you bought it for. Right?
Right.
But then you have to
Your cash
put
flow.
that. You have to pay off the outstanding mortgage, which is still that 800,000 that you spoke about earlier, which means in the bank you have 394,691. And so people will think, I put 240k in, I've got almost 400k out, I made money. But once you factor in all of the costs over that 10-year period, what you're telling me is that like a profit figure or a net cash flow figure, you're actually down $341,000.
Yeah.
That in essence, like there was an opportunity cost there that.
Yeah, well, I can already see people online commenting, oh, but you've got to live somewhere. It's a house. It's a roof over your head. It's security, which all is true.
Yep.
Like there is a I guess a cost in just having that security and a place to live, and it's yours. That is so true, and I'm not trying to shit on that. I'm just doing this from a rational economic point of view. That when people look at, they come to retirement and they say, oh, I've got this house and I'm going to sell it and I've made all this money on it. Have you actually?
Yeah. I think you protest a little too much. Like I think it's pretty easy to say the counterfactual of renting and investing in other ways compared to this. You would have been better off renting and investing. The challenge is we don't know the growth over the next 10 years. So look, that's probably an extreme example. 0% is probably an extreme example. You would think you would at least get inflation, maybe inflation plus.
Yeah.
So let's say you get what Perth got over the last 10 years. So
Okay.
Perth over the last 10 years, according to CoreLogic, grew 35%.
All right. So
Now, for people trying to do the maths, 35% over 10 years works out to be a bit over 3% a year growth.
very achievable.
So
35% means that my sale price over 10 years is 1.62 million.
Yep. So you feel pretty good. You bought a place for 1.2 mil. You sell it for 1.62. 10 years later, you're thinking in your head, hell yeah, I made 400 grand on this thing.
Yeah.
And I built some equity over the journey.
Having said that, though, after everything, costs included, you actually walk away with $70,000.
Yeah. Yeah. So once you subtract all your costs over the 10-year period.
Yes.
Yeah.
So
walk away with is a confusing statement here. But
sorry. Yeah. Your profit is $70,000.
Yeah.
People, I think, buy on this feeling of it doubles every 10 years, but you can see how you need to think about all of this.
All of the costs.
All of the costs, before going into it. Well, not before going into it, but just rethinking how you think about your principal place of residence.
So let's jump ahead because we've done some of the maths here. If mortgage rates are at 6% and all of these costs that Bryce have put in are sort of broadly accurate, to get to like a break even once all your costs are factored in, you need to be doing a bit over 4% a year, which is about 50% growth over 10 years.
Yeah.
So that's kind of the baseline for
the numbers I've put in.
For not losing money over a 10-year period on property.
Yeah.
So if it's growing less than that, once all your costs are factored in, you could be losing money on property.
100%. And there's a lot of things that go into here. As I said, there's no lender's mortgage insurance because a lot of people these days, unfortunately, don't have the capacity to do a 20% deposit. So you already have higher costs there. Interest rates, some interest rates these days are higher than the 6%. So I think there's a lot that could go into it that you really need to sit down and look at. But it's also just how you frame a principal place of residence as well. Like, I think a lot of people put all of their money into the housing bucket and think that it's going to double in 10 years and I'm going to be fine. I've got my financial freedom. But you still have to sell it to, liquidate that and actually get your cash. And then you need to sell it and hope that you've actually made a profit on it, because you could find that you've actually put yourself in a worse off position. Now, we don't need to go into what is the alternative if you do stocks, because we've spoken about that a lot. But
that's what this podcast is for. But look, we don't want people to walk away and say, Equity Mate's guys shitting on property again. Classic. Although, it's just like whether you're investing in stocks or whether you're investing in property, the quality of the asset matters.
Yes.
Because you want to be getting growth on that asset.
Yeah.
Just paying off a mortgage and building equity isn't enough when you start looking at all the costs that are also included.
Yes.
So I guess that's the conclusion.
That's it.
Yeah.
I've also realized that I haven't even put in here maintenance or furniture or anything like that. All of that goes into it as well.
In theory, you're buying furniture if you're renting or if you're buying. So you only want to be including the costs that are purely if you're buying.
The paint job.
Yeah.
Nice. Well, if you have an alternative opinion on that, or if you would like some more housing content, I should say, check out our YouTube channel, because we've released a conversation with Matt Barry where he gives his views on why property is the root of all evil here in Australia. It is absolutely going off on our YouTube channel and creating some great conversation. So make sure you go and check that out. All right, well, welcome back to Equity Mates. It is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. It is this time where we bring in a community member and an expert and get the community member's portfolio reviewed. And today we have, for the first time for Pimp My Portfolio, but not for the first time on Equity Mates, Charlie Viola. Charlie, welcome.
G'day, boys. How are you?
Yeah, we are well.
We're excited to have you for this segment, Charlie.
Yes.
Yeah, actually, I'm a bit nervous.
Are you?
Yeah. It's like, I obviously do this for a living,
Yeah.
but not in front of a whole bunch of people.
You're
It's
literally one of Australia's top-rated advisors. I think we're really excited for this. And on the line, we have community member Steph. Steph, how are you?
Hey, good, thanks. How you going?
Thank you for submitting your portfolio. So, Ren, do you want to kick off? What's in Steph's portfolio?
Yeah, so Steph has a portfolio. She's got 7 ETFs and 6 individual stocks. I would hazard a guess, Steph, that it's a bit of a core and satellite approach, with the ETFs making just shy of 90% of the portfolio, and then the individual stocks being the remaining sort of 12 or 13%. Some of the bigger ETFs, we've got Vanguard International Shares, we've got Vanguard Australian Shares, we've got the iShares S&P 500, and then a few more after that. In terms of individual stocks, a lot of Aussie names: Commonwealth Bank, Computershare, Treasury Wines, Westpac, Woodside, and Whitehaven. So, Steph, we'll ask you how this portfolio came to be. But before then, Charlie, do you have any initial thoughts on the portfolio?
Yeah, Steph, do you want a job? Like, I must confess, this is actually really pretty bloody good, to be honest. The way that
Oh,
you've
really?
the way that you've put
Oh
this,
dear.
whether kind of by accident or by design, you sort of 50-50 global and domestic, and again, I don't even know if you've done this on purpose, but even when I look through your kind of direct exposures, you've got kind of exposure to banks, tech, energy, consumer discretionary, resources. It's all like a really good split. So like my first thing is like, this is actually really well done.
All right, well, segment over.
Sure.
Well, Steph, with that in mind, maybe if you can shed a bit of light on actually how the portfolio came to be and where you're currently at with it.
Yeah, sure. So I fear I'm going to sound probably more wealthy than I am. I just happen to be surrounded by people that are kind of financially in the know a little bit. So for a long time, my mum was encouraging me to invest in shares and things like that. And then she sort of pushed me by, as a birthday gift, buying me a couple of shares in Combank, and I think it would have been Woodside. So she got me started with that, and I kind of just like watched them grow over a couple of months. So I was like, oh, okay, this isn't as scary as I thought it was going to be. So watching the Combank and the Woodside ones and just kind of getting familiar with the feeling of seeing things go up and down. I was using like Morningstar and stuff, and just sort of went with shares that were undervalued, which happened to be Computershare, Treasury Wines. There was like a trade happening or they were changing the trade deals or something at the time, and I just sort of, it was kind of specky because I was like, oh, I know that trade deal is going to go through. Like, I'm going to invest now because the stock is undervalued at the moment. Unfortunately, Whitehaven Coal, that was a specky one too. I mean, $1 or something a share. And I was like, oh, coal, that's going to go out the window at some time, and then they'll have to transition to like a renewable energy. And then they got a new deal, and they've got like a new site being built, etc. And that ended up being one of my best performing stocks, because they'll definitely continue to produce coal. So yeah, those all went well for like a year or two. And then I started listening to Equity Mates more, asking a few more of my friends and my partner at the time about like the stock market, etc. Listened to Get Started Investing by Equity Mates. I've got an understanding of ETFs and realized I should probably be investing in those instead of singular stocks. And yeah, from the Get Started Investing as well, kind of sharing it around. That's what the FTSE was about, trying to get in on the UK stock market, S&P 500, obviously, NASDAQ. I just liked the way that was performing. I know there's probably quite a bit of overlap with S&P and NASDAQ, but I was tempted by the big numbers. And then, yeah, VAS and Vanguard International, all that kind of thing. That's from there as well. The high yield one, Vanguard High Yield, that was supposed to be like almost like a blue chip or like my stable one, but I really didn't like the way that was performing, so I just stopped adding to it and have just let it coast where it's at.
Nice.
Well,
good summary.
Yeah, a lot to unpack there. I love the fact that you came across Equity Mates and you started investing in ETFs. It's, it's good to hear. But I guess, Charlie, from all of that, do you have any initial takeaways or any initial thoughts on where this portfolio could go?
Yeah, so firstly, it's a really good lesson, isn't it, in terms of kind of doing a bit of research and doing a review and having a look at, where value is at and what valuations might kind of look like, and kind of finding resources like Equity Mates. I mean, I think the Equity Mates commercial can be over now, but
It's never over, Charlie. It's never over.
Morningstar and what have you. So it's a good lesson to investors, especially people kind of starting out, in terms of how to kind of put these portfolios together. It's really hard to be critical of this portfolio. I would say the only one, you've probably already highlighted it, the bits that I think that you could probably pull out of this and kind of make a couple of the other positions more material, to be honest, a VHY. We're not a big fan of VHY, which is the Vanguard High Yield. It obviously just goes and finds the biggest dividend paying stocks with no real kind of consideration for value. honestly, you might as well just keep tipping that money into VAS or the other kind of broad-based ETFs. And then the other one is VDHG, which is the Vanguard Diversified High Growth Fund. It just kind of dilutes the message a little bit in terms of, when you're investing in that one, because you're actually covering all of the other things in the other stocks that you've got, or in the other ETFs that you've got. So, I would probably cull those two out. I'd increase the amount that you've got in, VAS and IVV, or even sort of NDQ if you kind of, like the tech space. In terms of the direct stuff that you've got in there, I think Whitehaven Coal has probably got some room to run. I think, Woodside is probably the same. I think the banks are probably maybe a little bit overvalued now, but, kind of long term, they're absolutely fine, and they'll continue to do reasonably well, especially the ones that you're holding in terms of, CBA and Westpac. We're not a massive fan of Computershare, if I'm really honest, but it's got a huge amount of market share. But I think as that sort of space becomes far more competitive and new registries come to market, I think I'd probably happily take the winnings there and maybe stick that money into the kind of broad-based ETFs, especially if this is now kind of the set and forget portfolio.
Yeah, pretty much. That was my goal.
Yeah, honestly, you've done an exceptional job putting it together. There's bits and pieces of changes, but not heaps, if I'm really honest.
Love that. Well, Steph, are you still actively investing into it at the moment, or is this something that you just want to have ticking away?
So I was actively investing up until, 3 months ago, and I sort of started to get a little bit overthinking my portfolio and going, I don't know whether to keep investing in VAS and VGS. I was actively investing in those. The rest I was just kind of letting sit, occasionally putting into S&P 500. And I thought, okay, well, if I can't make a decision, then just cool the brakes for now. And now I'm doing salary sacrificing additional contributions into my super. So the plan was that I'd do that additional contributions for 12 months, see how I feel, and then either keep doing that or start adding to my investment portfolio again, mostly just into the ETFs. And it's pretty much because of salary sacrificing, the amount that I was setting aside to invest into ETFs, it's exactly what is now going into my super under salary sacrifice, but an extra $100 and $50 or something because of the tax concession. So it sort of felt like free money doing that for 12 months as well. Which again, not to, hammer it home, but after listening to the super episodes from the podcast, I finally was okay, now I understand why people salary sacrifice into super. So yeah.
Well, I think after Charlie's comments, if you ever do switch it back, or at least try and do perhaps both as well, because you would have heard that we're strong proponents of trying to also build the portfolio outside of super as much as you can as well. I think you've certainly got a portfolio there that is set up for a decent DCA strategy anyway. So
yeah, I agree.
Yeah, it was reassuring to hear that the approach that I was taking was sort of the right one anyway, because I had stopped investing into VHY and diversified high growth. I'd sort of stopped actively investing into those and was focused more on VAS and VGS. So it is reassuring to hear that I was making probably a good choice.
Yeah, they're absolutely the two that, if you're adding small amounts to, that you'd be adding small amounts to every month. They're the most diversified, broad-based exposures, and you'll obviously get the benefits of that kind of dollar cost averaging over time. And in reality, if you've got control of your super monies as well, this wouldn't be the worst sort of long-term super portfolio either. So if you're doing the exact same thing into super, then this mix and this type of portfolio is going to generate good outcomes over the long term, especially if you're kind of adding to it on a regular basis.
Nice.
Good.
Wow.
Good.
Well, you've set the bar high for everyone else who comes in afterwards, Steph. So look, we'll leave it there. Thank you so much for submitting your portfolio. I hope you took something out of that. And Charlie, thank you so much for sharing your thoughts with Steph.
Awesome. Thanks so much, guys.
Well, if you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. All the information is there. But yes, Charlie, once again, great way to kick off. Thank you so much.
No worries.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.